we didn't give our normal amount of heads up for this event because we just kind of decided to do it, and I wanted to get it in while it would still be meaningful information for the fourth quarter of the year. Steve Mayhew and the IM&R team agreed to do this kind of special webinar for us to give the advisors at W&P a chance to kind of hear their thoughts on the investment environment and what the moves that they are making for the portfolios that they manage, and also just give us a general idea of what's going on in the marketplace. And I thought, you know, we do a lot of client meetings in the fourth and the first quarter. It seems like we probably do an inordinate amount of reviews during those 2 quarters. So I thought, you know, this will be a nice opportunity for everybody to maybe get a little bit of helpful information as they prepare for those meetings and they start thinking about investment allocations for 2020. So anyway, I'm glad everybody's on. Please take advantage of the time here. I think Chris Cericchio is going to get us started. And further ado, Chris, would you kind of get us going and then just introduce folks as we go along? And I assume you're expecting people just to ask questions as we go along, but I'll let you tell us how you want that handled.
All right, John, this is Steve Mayhew. Thank you very much for giving. Hi, how's it going? Thank you very much for giving us the opportunity to talk today. We're glad to do this. Today, what we're going to do is we're going to talk about a few of the products that we think you should really be taking a look at in the fourth quarter and into the coming year. And in that regard, we're going to have Steve Mueller discuss the minimum volatility portfolios, or the managed volatility portfolios. Ted's going to talk about our stock portfolios. Brian will talk about our bond ladders and give a fixed income outlook. And then we save the best for last with Chris, who will give us the predictions for the world in the fourth quarter and go forward. So again, thanks for the opportunity. And we are going to kick it off with Steve Mueller, who is going to give us a talk on the managed volatility portfolios, and we will have plenty of time for questions because we know that's what you want to do. So this is an opportunity for you all to give us all the questions that you want. So.
And Steve, I figured we'd do each segment, and then if there are any questions on that segment, it would be timely to get there before we start the next segment.
We're just waiting for you guys to change screens over to you.
Okay.
We made you the presenter, so you guys have to get your screen going.
1 second here. Angie. Screen. Where's it say? Didn't ask me to accept the screen like it did last time, Angie. You don't see our screen? Let's see here. Share. There we go. Sorry about that, guys. There you are, Steve. Sorry about that.
All right. Can you all see the screen? John?
Yeah.
Okay.
Oh, yeah.
Great. So with that, I'm going to turn it over to Steve Mueller, CFA, and our senior research analyst, who's going to kick it off with the managed volatility portfolios. You can ask him questions, and then he will pass it on from there to Brian. All right?
All right, thanks, Steve. So our ETF managed volatility portfolios are our most recent launch. Back in April, they hit a 3-year number. I'm going to walk you through just a quick introduction to factors for those of you that aren't familiar with them. Talk a little bit about how we came to settle on managed volatility, and then how we build the portfolios, as well as set expectations moving forward, and how you can use this portfolio with clients. So this is our first experience with a factor-based portfolio. Just to run through some of the other factors that I'm sure many of you are familiar with. There's value, which deals with valuation, PE ratios, price to book ratios, size, playing on the size premium, something like an equal weight portfolio that puts heavier weights on the smaller cap names within an index. There's momentum, which is typically based on price momentum, quality, which focuses on quality balance sheets, low debt equity ratios, dividend yield, which is pretty self-explanatory, and then managed volatility, which is what we focused on this. So the reason we decided on managed volatility is it actually started with an advisor that had a specific client case. It was a very wealthy client, and they wanted us to manage the equity. They wanted to be in the market, but they didn't want to have market risk. So we started thinking about ways as to how we can minimize downside participation. And we started doing some research into managed volatility. And what we found is out of all the assorted factors out there, based on back testing and even live track records, managed volatility investing maximized the historical Sharpe ratio. So we figured that was a good place to start. We started doing a little bit more research into it. We found that there actually is a volatility anomaly out there where you're always taught that the more risk you take, the better your return. That may be true for the lowest volatility quintile, actually produced higher returns over the last 25, 30 years. So we decided to move forward with that. There's a lot of products out there, which I'll get into momentarily, that we could build a fully diversified portfolio, blend it with our asset allocation, and put together something that allows clients to participate, but potentially protect to the downside. So depending on who the index provider is, they build their managed volatility portfolios differently. This is an example from MSCI. The way they construct their managed volatility indices is different from how S&P or Russell may go about it. So for this reason, we diversify our index providers. MSCI, for example, they use rolling 3-year volatility and optimize a portfolio on that. They try to minimize tracking error, maintaining sector weights that are closer to what the market cap index has. S&P and Russell do it a little differently. They look at strictly trailing 12-month volatility and weight the portfolio inversely based on the volatility of each individual stock. What you can end up with is very large weightings in certain sectors, whether it be real estate or utilities or financials. And for this reason, we try to diversify our index providers. So we use a mix of Spider and iShares and Invesco because they each use different index providers to create their products. So with that, we created 3 risk levels. We have the high equity, the capital growth, and the income and growth. So we overlay our global diversification, long-term strategic asset allocation. And what you'll find is that the managed volatility products are only available for equity. So for the fixed income piece, it looks very similar to our regular ETF models. The allocations and the securities are going to be pretty much the same. So does it do what it's supposed to? Well, as you can see here, it's not a silver bullet. There are times when the managed volatility portfolios will draw down a little bit more. The idea is that over a market cycle, 5 to 7, 10 years, it will reduce volatility. As you can see here, during the 4th quarter of 2016, the shaded area is the high equity managed volatility portfolio. It did lose more than the benchmark. A lot of that had to do with some of the sector weightings. Fast forward to 2018, and it held up much better. During the fourth quarter, it lost less than half of what the MSCI ACWI did, and about 60%, maybe 65% of what our high equity benchmark lost. So how does this translate into overall performance? Since inception, which was April of 2016, the portfolios have more or less done what we have expected them to. They've captured between 80 and 85% of the upside, which is consistent with our research, and to the downside, roughly 60 to 65%. So this translates into a much better Sharpe ratio than the benchmarks. It also produces pretty significant alpha, and returns have been right in line with the benchmark with far less risk. So the idea is that you'll use this with clients that are potentially a little skittish about the market, because I'm sure you've all seen this slide in one form or another. The idea being that when you miss the best days of the market, for example, if you miss the 15 best days of the market over the last 20 years, you cut your account by nearly 2/3. So if the managed volatility portfolio, through limiting downside, can help you keep your clients in the market, keep them invested, we believe that it allows you to help your clients meet their financial goals. So just a quick review of the portfolio. We apply multiple layers of risk management. We use the managed volatility indices for our equity exposures. We diversify the index methodologies to prevent unintended sector bets. On top of the managed volatility ETFs, we apply our CAAMS asset allocation. We offer it in 3 different risk levels, so there's something out there for pretty much every client. And then the overall goals of the portfolio, hopefully it can lower the beta of the equity. It allows participation in up markets while potentially limiting downside in market pullbacks. So with that, I'm going to open it up to questions.
I'm going to ask Angie if everyone's muted.
Angie, is everyone muted?
Not to my, no. Okay, I just checked it and I just unmuted. No, not everybody's muted, no.
All right, if there are no questions, I'm going to pass it on to Brian Moran to discuss our fixed income.
Thanks, Steve. I'm Brian Moran, Director of Trading. Just a few notes on the fixed income. Okay. Starting off with our example portfolios from recent inventories, our investment grade corporate portfolio, and this is obviously a few days ago before the spike up in interest rates this week coming into the Fed meeting. Our investment grade corporate yielding about 3.10 to maturity with a modified duration of about 3.3% and a current yield of about 4.86%. Our national muni bond portfolio yielding about 1.8 to maturity with a modified duration of 3.24 and a current yield of 2.53. One of the things that you get from a laddered bond portfolio that you may not get from an open-ended mutual fund in the high net worth space is a certainty of return. That if you hold a portfolio from inception to maturity, barring calamity, you're going to return what the inception yield is. So despite the move up and down in interest rates, portfolio we implemented today, we would expect about a 3% return over the life of the portfolio. If interest rates move back up, reinvestment could enhance that yield over time. So there is a space in an investment portfolio for fixed income, and in particular laddered bonds. One of the key benchmarks that we use for the investment committee when we're looking at fixed income is the U.S. 10-year. This is a look at the U.S. 10-year over from 11/1/18 through 10/28. We peaked out at about 325 11/8 last year and reached a low of 145 on September 3rd. And as recently as the 28th, we were at 185 yield. And as you can see, there's a significant move up, to move 40 basis points in just under 2 months when we're expecting a rate cut from the Fed shows that the fixed income markets are starting to heal, and that the implications of the Fed rate cuts are being felt in the fixed income markets. That they're feeling the future outlook for the economy is a little bit better than it was at the beginning of September. So here's the active Treasury curve comparing last November with October 28th. As you can see, there's a significant kick down across the entire yield curve, and the front end of the curve is still a little choppy, but the pronounced inversion that was occurring earlier in the year has pretty much flattened out. With the next move down from the Fed, which is occurring today, they announced a 25 basis point rate cut, and probably another one to come in December. That inversion at the beginning of the curve should completely disappear. When we take a look at the current active markets, we have the investment grade corporates up top, the active treasuries in the green, and the munis below that. Overall, the spreads are consistent with a healthy fixed income market. One area of concern for me is the municipal curve doesn't cross over the treasury curve until we're out at the 14-year mark. Normally, I like to see that between the 5 and 10-year mark. This is reflecting the flight to quality and people moving into munis as a result of the changes to the tax code. In general, there's been a chase of yields that have held yields down over the past few years. In particular, the spread between investment grade corporate and munis and treasuries is still a little bit suppressed. Although we're starting to see some slack appear in the below investment grade to get those risk premiums back into the junk bond space. One of the things we look to see what's going to happen in the future from the Fed and in general in the markets and economy is the implied inflation, which you get by taking the active treasury curve and the inflation adjusted treasury curve. So right now the implied inflation at 2 years is 1.2%, out at 5 years 1.56, out of 10 1.66, and out at the 20-year mark 174, all of which are below the Fed's target of 2%. So here's a look at the upcoming Fed meetings. Obviously, today's was a quarter-point basis cut. I suspect we'll see another quarter point in December or January, despite the dovish, we're a little bit more hawkish tone from the Fed on the statement this time. Surprising thing about the Fed statement, it's a little shorter than a Fed statement usually is. I haven't seen what the reaction is, and we'll obviously be watching Chairman Powell's statements carefully during this upcoming press conference. So with that, if there are any questions.
Hey, Brian. You do custom ladders. Can you give us some input, like on what what demographics are you looking for? Minimums, holding duration, et cetera. What do you look for then?
So our the minimum for the portfolio is $250,000. The average portfolio is somewhere just north of $400,000, and we'll build in state-specific muni, national muni, investment-grade corporate, and we have built some recent treasury ladders or combination ladders that use treasuries as a base and have an overlay of investment-grade corporate or municipal, depending on the end investor's desire. So with the individual fixed income securities or laddered bonds, usually we're looking for the little bit higher net worth, higher value. We often see them paired with either an ETF portfolio or a stock portfolio to get the equity exposure from either stocks or ETFs. And then you use the fixed income as your essentially anchor to the portfolio, to the overall asset allocation.
Got it. Thank you.
Anything else? And with that, I'll turn it over to Ted with the little insight into the stock portfolios, which really do pair nicely with the fixed income portfolios. Here we go.
Thank you, Brian. Okay, so let's start things off here. Just going to do a brief overview of the CAAMS stock models and our process, as well as delve into a little bit of performance also towards the end. But first off, let's look at some general info. CAAMS stock, 100K minimum, but we do have some wiggle room to go a little lower than this. We have 6 models overall: core, core equity plus, global equity, capital appreciation, equity income, and dividend growth. And with our portfolios are fairly concentrated, anywhere from 24 to 30 holdings, but we still do have a focus on maintaining a level of diversification within these portfolios. We are multi-cap, but we definitely are large cap leaning when structuring our models. We do offer tax loss harvesting for CAAMS stock. So around mid-November or so, you should get an email from us to advisors that use the CAAMS stock program to remind you of this service. And then lastly, we will rebalance the portfolios when positions hit certain thresholds. So let's go with just a quick dive into each model. First, let's do core equity. It's comprised of 24 stocks, each equally weighted, and they're selected from the S&P 1500 index. Core equity is our most diversified portfolio, as it is focused on allocating to the 24 industry groups as defined by GICS. But though we are not mandatory to have allocation to each one of those 24 industry groups at all times, we have the flexibility to exclude industry groups from the portfolio, and we also can double down on industry groups that we are bullish on. Next, let's do core equity plus and global equity. These, in a sense, are just extensions of the core equity model. In regards to core equity plus, we utilize 3% positions to the core equity holdings, and then with the remainder of the portfolio, we utilize the iShares ETFs of the S&P 1500 indices. As for the global equity portfolio, in addition to the core equity holdings, we utilize ETFs for developed international, emerging markets, developed international small cap, and frontier markets. Capital appreciation portfolio, we hold 30 aggressive model, though we do have constraints in place on maximum sector exposure. So we're not typically as aggressive as your typical large cap growth strategy as a result. We also can utilize ADRs, we can utilize holdings outside the S&P 1500, and you will see us make more concentrated bets on specific sectors. Next is dividend growth. This model holds 25 stocks, also all equally weighted. And obviously with the name dividend growth, we're focused on companies that are growing their dividends. We don't have a yield requirement on this portfolio. If a company ceases to grow its dividend after 6 quarters, they will be removed from the model. And as is the case with all of our models, we do a focus on diversification, and we typically do not go more than 25% in one sector within the dividend growth portfolio. And lastly, there's equity income. Similar to core, this portfolio hosts 24 equally weighted holdings. One big difference though, is that we do utilize 2 dividend-paying ETFs. We look to manage a yield that's well north of the S&P, and as with all of our models, we do focus on diversification within this portfolio. Now, what I'd like to do now is, those are the models that we have, but let's dig into the process on how we pick stocks for the CAAMS stock portfolios. First off, we start with 3,000 individual stocks. Now, where do we get 3,000? Where do we come up with these 3,000 names? Start with the S&P 1500, and then we add stocks outside of the S&P 1500 that are rated by the equity research providers that we utilize in the managing of CAAMS stock. And we'll continue to add to this list as new IPOs come out and things of that nature. So this list does evolve over time. And then on a weekly basis, we will load these stocks into a spreadsheet with several data points, and these stocks are then ranked on based on ratings and ratings upgrades. And we'll organize these into a based by their industry group as well to provide a more useful comparison. Now, as far as CAAMS stock, we rely heavily on sell-side research, and the sell-side providers that we utilize currently are S&P, Value Line, Argus, and Zacks. We also utilize some investment banks such as JP Morgan, Credit Suisse, and we have access to all the research reports that these providers offer to us. Common questions I get asked is why sell-side research, and a reason for that is that sell-side. I should go back here. Bear with me 1 second here. I'm having some issue here. What is going on? There we go. Sorry about that. Common issue, sell-side research and why we utilize sell-side research. Apologize for that tech issue there. And the reason is that we are looking for a level of expertise in all these companies that we are utilizing. And the analysts that we have access to are experts in their respective area of coverage and company management. They're experts on company management. They know the customers. They know the suppliers. They understand the competitive landscape. They're familiar with the key metrics that impact the space that they cover. And all this adds up to them having better insight on these stocks and knowing what inputs to use and when they compile the valuations for these models. And this is extremely important because even the smallest change in any input could have whether it's a discount rate, a growth rate, can have a huge impact on the valuation of that company. Take this a step further, sell-side research providers often utilize different valuation methods. We're looking over 3,000 individual names, and these are all companies from different industries. They're at different stages of growth. They may or may not pay dividends. By using sell-side research, we rely on their expertise to decide which is the right valuation model or models for that particular company. Let's go over here. And then now what we want to kind of delve into now is, once we compile all this data, what do we do next? For those stocks that score out very well, we do a deep dive. And the first thing we'll do is we'll delve into the different reports that we have access to from our different equity research providers. Then we'll even I'll go on Bloomberg and I'll see if there's any other sell-side reports that are made available to us, and I'll utilize those as well. Then we also do a 3 to 6 month look back on what types of stories or headlines pertain to these stocks. Headline risk is a huge issue nowadays and can significantly impact the price of the stocks that we're looking at. And then finally, we'll look into transcripts from most earnings calls. These can give us an idea to management's thinking. And what also is helpful with this is we see what kind of questions the analysts are asking management, so we kind of know what the key topic areas are with each of these stocks. And lastly, we do everything I've said up to this point has been very much focused on the individual stock. We are not just a bottom-up approach. We do take a look at the global economic landscape and see what, other things that can pertain to, that could impact our portfolios, China impact, interest rates, political climate. So we're not just, basing everything on the individual stock level. We will apply what's going on in the global economic landscape to making our portfolio decisions. And lastly, the last step we'll do is, Chris and I will get together and we'll do a basic SWOT analysis. We will do a basic strengths, weaknesses, opportunities, and threats. So for strengths, we're looking at things like brand recognition or customer loyalty. For weaknesses, is there too much debt on the books? Is there management issues? Opportunities, merger and acquisitions, Do they have a new product? Do the technological improvement? Is there a new customer? Things of that nature. And lastly, threats. Is there, has Amazon entered their industry? Has there been changing regulations? And then, things of that nature. And lastly, our final is just to decide to whether or not to add the stock or move on to a different opportunity. The probably the hardest thing of what we do is when to sell. It's a question we get asked a lot, and that's probably the hardest part of our what we do. And change in the company, for example, is there loss of a major customer, questionable acquisition? Also, leadership. Has there been a change in the leadership of the country, of the company? Did did they have a rock star CEO who suddenly decided to step down? And we'll also look at the average target price of the company. I pair that with catalysts have diminished because we do see, especially the past few years, that companies will approach their average target price from analysts, but what will happen is that the growth catalysts are still there, and just the average target price gets reset higher. So if we see average target price and we feel that the catalysts have diminished, you could see us sell in that situation. And then finally, there is headline risk. If there has been, I referenced this earlier, if headline risk has become too great for a company, we will sell the position. Example of this would be our recent sale of Altria, where we the concerns around vaping and lung disease became too great, and we decided to exit our position. Last thing I do want to touch on is just performance overall in the portfolios. So far in through the third quarter, our core equity and equity plus and div growth models have topped the S&P in the year, while CAAAP is close to being in line with the S&P, and equity income and global equity have lagged a little bit. Moves that have helped us this year overall, our decision to utilize real estate across all of our models has been very, very beneficial to portfolios. Real estate's done extremely well, and our holdings in real estate have done especially well with companies like Equinix, Prologis, American Tower, and Essex, all besting the S&P as well as the real estate sector in general. Also, what's benefiting us is our stock selection with the pharmaceutical industry group. Pharmaceuticals has been one of the worst performers year to date, and it's roughly between 7 and 8% of the S&P. And our holdings in that space have provided us a nice performance and have done extremely well. Thermo Fisher, Merck, and Zoetis all have been strong performers. And the one thing to point out, though, Pfizer is also something we hold that has not performed well this year for us, and it's also one of the reasons why equity income is lagging a little bit. And one of the other things that's really helped us is defense stocks. All the defense stocks have been huge contributors to the portfolios, and we have a pretty healthy dose of defense stocks across the board with Lockheed, Raytheon, Northrop Grumman, United Technology, Honeywell, all beating the S&P by significant amounts through the end of the third quarter. And with the good, there's got to be some bad, and things that have held us back this year. We have low exposure to semiconductor stocks across the board. We avoided semiconductors because they are very much exposed to China. These companies get a significant revenue from China, so we've held a few names in that space, but it's not a space where we have a huge position. And there's been some rallies in semiconductors this year, and we've missed out on those. We have exposure to energy stocks across the board, and that with oil prices sliding since April, that certainly hurt us as well. Managed care is another area where we have some exposure. Managed care stocks have been negatively impacted by anytime the concern about moving to single payer. So after any Democratic debate, there's often been a lot of single payer talk, and that has sunk our portfolios a little bit at times. And then there's always the single stock issues that we try to avoid, but sometimes they happen. And Align Technology, Pfizer, and Tapestry have all at various times during the year had some performance issues that dragged down portfolio performance. So that is about it for me. I can certainly open up for some questions. If anyone has any questions on our process, what's going on within the CAAMS stock portfolios, anything on stocks in general.
Hey, Ted, it's John Parsons. I've got a question about taxes, and I guess it's in relation to the stock portfolios, but it may be also a little bit bigger question. One of the unintended consequences of a good market is when we make changes to these portfolios, we end up with some tax consequences. Is there anything that that you guys can share with us? Is there anything out of the ordinary that advisors should be concerned or aware of as they go into the last quarter of the year and preparing their clients or that may be either in the stock or really in the other CAAMS portfolios as well, if they're taxable accounts? Is there anything kind of, heads up or unusual activity that happened this year that we should be aware of?
Hi, John. It's Chris. So every year, right around Thanksgiving, we put out a notice to advisors via Advisor Week that we are happy to do any sort of tax loss harvesting opportunities, whether it's a gain or a loss, to help with their year-end taxes. And so with the broad portfolios this year, what you're seeing is some of the international holdings haven't done as well as domestic stuff. So we'll be looking to areas upon, it's going to depend on when the client entered into the portfolio. It'll be an individual decision. And this year it doesn't look, unless things change drastically like they did last fourth quarter, that there will be any sort of huge macro moves that an asset class completely fell out of bed and we're just going to sell everybody in that space and then buy a new manager. But in particular to the stock portfolios, one of the good things is, even if we do a good job of picking stocks, say we pick 20 winners, we're going to have 2 or 3 losers as well, unfortunately. And so what we'll typically do is go ahead and sell some of those positions, harvest those losses, and either give someone a future benefit or a current benefit, and reposition the portfolio in a way that we feel is beneficial. Ted and I have already been speaking on a couple candidates within the stock portfolio of what we're probably we like the companies, but I just think it's the quickest path to profitability for the client will be a tax loss harvesting.
And one other thing to add to that, John, this is Ted, is that we do, when we buy stocks, we're not looking, for a quick gain on these. Typically you see the moves that we make. It's, we're looking to hold these for the long term and, hoping that the gains will be a long-term gain versus short-term. So we do have an eye towards that as well when we're managing the portfolios.
John, hey, Brian Moran, on the one of the things you can do at the advisor level is look at the consolidated gains and losses at a macro level by using NetX. You can look through your client book and see what you've realized as far as gains and losses year to date. So if there are questions on that, you can always call the retail trade desk. They can point you down the right path at NetX to see that. Obviously, adept Allbridge users can pull some information from there as well. But for the stock portfolios and ETF portfolios, a lot of that information is right there in NetX to draw to look at when you take a look at your accounts.
This is Ryan. I have a couple of quick questions.
Any other questions?
Hey,
just one
Ryan,
thing I would like to add too is that
Yes.
Ryan?
Yeah, he's here.
I'm sorry. Yeah, I had two quick questions. One is with the tax situation. In the last couple of years, I've had a couple of clients that were buried by, having you guys doing like 100% turnover. And so at my level, it doesn't feel like you guys are paying attention to if we're marking off a tax advantage or tax sensitive. Can you explain what your process is and why a tax sensitive client would have 100% turnover?
So which product line are we talking about here?
CAAMS ETF portfolio?
2 years ago, is it 2 years or 3 years now?
2016.
Yeah, 2016, so 2 tax years ago, we did a major realignment of the ETFs to lower the expense ratios and better align.
By 10 basis points? I mean.
Well, the portfolios are built for the long run, and for some of the long-term holders of the portfolio, it did cause some realized gains that unfortunately there wasn't an easy way to avoid it. Obviously,
so what about just communicating with us so that we had an opportunity to opt out? I mean, I've got clients that are in like an effective bracket of above 50, and like to have 100% turnover just sours relationships. Like
we did take that as a lesson learned from that experience, that we'll be more precise in our communications and preemptive with some of the options available on that. But that was really probably a once in the, like, since we've implemented these portfolios 18 years ago, that's the first time we've ever had a realignment that massive in one single year. And it was really more event driven, and it was something that had to happen to get to set up for the future and for the long-term growth and health of the portfolios. It was time for some realignment and adjustment to the positions. We should have communicated better, I'll certainly admit that. And I don't anticipate a move similar to this for another probably 5 or 7 years at least. And we'll.
So you're saying that you will.
We'll communicate a lot better on the front end. We'll telegraph that we're going to do a significant realignment. If we're going to do that again, we certainly would have let people know that we're going to take some of the gains in our large cap positions that were the real drivers of those gains. We had an 8-year bull market, and unfortunately, when we realigned, there was not much to offset those gains in that year.
Yeah, Ryan, this is Steve, just echoing Brian's comments. That was a lesson learned, but also because people invest in the ETFs. We had some going back to 2003, others who invested in 2014. The tax consequences were very different. And that's a lesson learned on communication. We did have advisors that saw the moves, looked at their clients' portfolios, called us up, and I think we had 90, 120 days. We did reverse positions. Jeff Kaplan was one person in particular. He had several multi-million-dollar clients. So
well, that's great. I mean, but you just buried us and blindsided us. I mean, it was horrible. I mean, sorry, but I mean.
No, Ryan, that's, again, we've been running these portfolios for 16 years. That was right. 1 year, 2016. In 16 years, we had 1 year where we made a major realignment. There was a lot of changes we did to the portfolio. It was not just for expenses. That was one reason. It was also new products in the market. When I rolled out those portfolios in 2003, there was only iShares. So we had been talking about it for a while, and we did not communicate far enough in advance what we were doing, nor did we analyze the depth of the problem with some of our earliest portfolios that had huge gains. Yeah. Well, some of us did, but the communication was poor. Yeah. So
it soured some relationships, and I really hope that you will communicate a little bit more effectively. You know, it would be helpful, because high net worth clients don't just fall out of the sky every day. You know, and it's ruining relationships is a very tough thing. Second, I had a question. When clients are wanting to put money in on a monthly basis, and I'm sure other advisors have had this as well, where clients want to consistently dollar cost average on like the first of the month. And we don't really have that flexibility with you. We have clients putting in $5,000, $10,000+ a month, and you guys seem to invest the money when you guys get around to running a high cash report. Can you tell me your general philosophy on that, or how you guys approach that, or how often you're running the report?
As deposits come in, we evaluate the accounts depending on the impact of the deposit to the tolerances on the positions that may or may not trade. So if it's a $500,000 account and you put $10,000 into it, that may not move any of the positions significantly enough to trigger a rebalance of that position.
So how often are you running the reports?
When the money comes in, we run the report. We're doing sampling and review on a daily basis. usually we'll do the cash outliers on a regular basis, usually at least quarterly, but on the we're doing some drill into that on a almost daily basis, looking for those outliers. But with a small deposits in large accounts, that cash may be within tolerance, or the rest of the positions in the portfolio may be within tolerance, and the slack will stay in the cash.
I don't think I follow. How often are you running the report?
We do a high cash sweep at least quarterly. We do reporting. We do review of all deposits that come in.
Is that a daily function?
That's a daily function.
So you're running the reports once a quarter?
We're running reporting daily. We do a sweep of high cash on a quarterly basis. So with high cash out of tolerance, so if the daily report didn't trigger a rebalance, that'll sweep into it may take until the quarterly report to true that up. If you have a specific example, we can take that offline and put some special handling around it.
I think your question, Ryan, is when you deposit the money, is it automatically reinvested, or why is there a delay? And the answer is it's not automatically invested. Okay. It's not.
So I guess it just may not be the right vehicle then. Okay, I get it. And then the third-party managers, are you guys overseeing them as well from a cash deposit, or?
I'm sorry, I just wanted to be clear, Ryan. If you're saying, is it part of our program to automatically reinvest small cash deposits, the answer is no.
Not unless they trigger a tolerance of the positions to be rebalanced.
And what is the tolerance? So
if that cash doesn't position out of tolerance, it may not trigger a rebalance.
Okay,
it's for
and then
it's for tax consequences and creating noise on the portfolios. That we don't want to generate unnecessary activity for the client. We run the rebalances to tolerance. Portfolios are traded to tolerance. That the variance in the position relative to where it should be in the portfolio is how we calculate the rebalances.
I understand. Clients are putting in like $5,000 and $10,000, and they were just hoping to get it invested. But I'm seeing it's just maybe not the right vehicle to accommodate what the client wants. Switching gears to a third-party money manager, are you guys oversight on those as well for the for the managers that we have as part of third-party money managers? Are you running reports on those as well?
Yes.
And how often on those reports?
Almost daily. They're
almost daily, because I've got a couple clients have been sitting in cash for about 60 days now.
Send us an email to CAAMS Trading. We'll take a look at it. We'll lean on the managers. Some of our, depending on who the manager is, some of our fixed income managers have been sitting on their cash. And from my perspective as a fixed income manager, I can see their logic in it. That if you're making 180 in your cash vehicles and you expect to implement it at 110, well, you're adding 60 basis points or 78 basis points to the portfolio by waiting a little bit till your target positions normalize, or where you're going with the opportunity.
And where do I send an email to? CAAMS Trading or?
At Lincoln Investment.
Perfect. Thank you.
Hi, everybody. It's Chris Cericchio. I want to thank everybody for taking time out of their day to meet with us here and spend some time together. In addition, I want to thank John and Angie for helping put this all together. And hopefully you find it beneficial. So I'm going to go through a third quarter review and talk a little bit about fourth quarter outlook. So when I did this slide, it was before today, and as a result, we now have a third quarter number, which came in at 1.9, but you can see that growth has been slowing here a bit. Good news is that it's interesting that the Fed, New York Fed, came in closer with their estimate of 1.91, pretty much spot on with it. So you can see the economy is kind of slowing a bit here. We have profits, so we now have a handle, not complete number on the third quarter profits, but profits are probably going to drop about 3.5% from the third quarter of last year. That sounds bad, but the market had been expecting a 4% decline. So as a result, the glass is half full rather than half empty, and so the market's been moving higher after a choppy beginning of the month. Another part of the economy is the jobs. The jobs numbers remain as good as they've been in my lifetime, and so you would expect them to deteriorate a little bit before we would hit a recession. Jobs aren't necessarily a great indicator, but it's, there's a lot of talk, are we going to hit recession? With the jobs numbers where they're at right now, it is not easy to see us hitting, people fully employed, making money. It's unlikely that the consumer is going to roll over on this. Next slide is the wage growth. So the nice part about wage growth is who's been experiencing the wage growth, and it's a lot of people sort of in the lower income strata. So when they have more money in their pocket, they're much more likely to spend it. And so again, that helps move the economy along in a nice fashion. So the jobs numbers and the wage numbers have been beneficial. Two things I look at a lot are the leading economic indicators and also the yield curve. So we had September data come out recently, and what we saw was a modest revision to August from a 0.1 growth to a 0. And then we had a slight decline for September. So, I am taking note of that. On the right-hand side, you can see 6-month growth of leading economic indicators. And throughout this expansion, there's been occasions where it's flirted with 0 growth over 6 months, but it's tended to rally back. You can see from the last 2 recessions that typically you see a decent lead time before the recession kicks in. So the leading economic indicators, I'd love for them to be better, but they're certainly not flashing recession. However, one thing that I think we can all agree on is that the global growth story is deteriorating. Remember, while everyone was really happy, global synchronized growth was experiencing, we're now, in the words of the IMF, experiencing synchronized slowdown. So what's interesting about the IMF's projections are 2019 slips from where we were in 2018, but for many, for the global economy, 2020, they seem to see a resurgence in green growth, so a little bit better number. And what's more is that growth seems to be coming from the emerging markets and the developing economies. You can see they also have a bit of a swoon here in 2019, but they are projected in 2020 to pick back up. So that's sort of the global growth story. It's certainly impacting us. Now the yield curve, the other indicator I talked about, liking to look at a lot. So this yield curve, there's a whole lot going on. You got some inversion in there. You got a relatively flat yield curve. You've got some positive slope from the 5-year out to the 30-year. So, what does this yield like? The yield curve is telling you that the Fed is going to continue to have to lower rates, and that those rates may be lower for longer. And so, I also think the yield curve would be steeper if we didn't have so much international buying coming into the marketplace. But all in all, you do have from the 5-year out to the 30, you have a nice normalized slope, albeit of this is a pretty tight scale here. So I don't want to make it sound like there's a lot of yield out there. This time last year, if you had told me that we were going to have these big gap downs, you can see, the purple line is where we're at earlier this month, and where with the brighter lines where we were last year. Really massive movement, especially on the scale of that. If you think about 140-point decline there around the 5-year, that's an enormous move on that. Half of the yield went back. So if you had told me we're going to have experience in that, I would not think things would be as good as they are right now. I think it does speak to a little bit of the global turmoil and the slower growth that we're experiencing due to all sorts of issues such as trade tensions. Now, one thing that had gone away earlier in this cycle, we saw negative interest rates come in. We actually got away from them for a while, by and large. They've made a pretty good resurgence here. And so you can see where, even where we were earlier in the summer to where we are now, rates have dipped in the US, and you've got much of the developed world in zones that have negative interest rates. Japan, a lot of Europe. To me, it doesn't seem like it's worked anywhere. I think it's deflationary by nature. I think it puts a lot of stress on their banking sector. And I think it also has a perverted sort of anti-growth piece to it. And by that I mean, if you're a saver and you're saving for retirement and I need to start saving more to get my nest egg in there for retirement, what does that mean? That means that people are spending even less. So it's having a perverse impact on the state of consumers in a lot of those areas. So that's the environment we live in. I'll think a little bit about the market. And I get this from Barron's, and it kind of gives you some good longer term perspective. But for starters, I'd like to take a look at where we were in January and where we are now. You can see that we've had a sizable move on the S&P 500. And you can see on the fourth row down, earnings. Earnings have went from 122 to 135. So, roughly 10% or so higher. But the market's higher than that. So and then you see the PE ratio going from 20.6 to 22.3. And I see some other indicators that also kind of speak to the market being a little richer. The dividend yield has gone down, despite the fact that dividends have gone up from 56 to almost 60. And so, dividends throughout the course of this recovery and expansion have really done quite well. And that's why I think, when Ted was speaking about our dividend growth portfolios, it's been a good metric for the market to grasp onto. And so you've seen dividends grow. Now, we do have a dividend yield right around a little less than 2. So that's lower than it was in January. But if you look at the drop in the 10-year from just about 2.7 to 1.8, some of that explains that. But by most metrics, the market is getting a little richer, a little bit more fully valued. The price to book, dividend yield, PE ratio, all are higher than we were to start the year. So it got me thinking about, the question we've gotten throughout this whole expansion is, the U.S. has led the way for so much. Global diversification, does it still make sense? Is it broken? Is it ever coming back? So I've always thought, certainly, the price that you pay for an investment impacts your long-term total return. And so I think it's a nice piece by State Street talking about what are the more expensive pieces of the market. And you can see growth. People have paid up for growth. People have paid up for large cap. What are some of the less expensive pieces of the market? And there are areas that have been more sluggish with their growth. And so, the people haven't bought them as much. Needless to say, there are a number of value areas that have gotten out of kilter. And so, I don't know when it's going to come. It's been a terrible timing tool. I don't even attempt to do it as that, but I do attempt to use slides like this to explain the concepts behind global diversification. Although I think everyone's pretty familiar with it here. So are we, I had a friend of mine just text me yesterday, are we in 1929 territory? Is the market about to fall apart? Is the global economy going to get shredded? And I think JP Morgan does a nice job with this slide book. For those of you who are at our meeting with Dr. David Kelly, he spoke to this a lot. And you can see, yes, the market is not cheap. I don't hear too many people pounding the table and saying this market is ridiculously cheap. Having said that, if you look at 25-year averages and standard deviations from that, it is higher than the average, but not so much that it's unsustainable. And if you look at a number of the metrics up there in the right-hand corner, where we are, and you can see a lot of them are right in line for 25-year averages. Certainly the CAPE stuff gets a lot of attention, and the price to cash flow gets a lot of attention. And they're right. I mean, the people are right to say that there are ways of looking at this market and saying it's overly priced. Having said that, there's a lot of ways to look at the market. No one has a lockdown on the only way to look at it. So here's a couple of ways of viewing it. And that tells you a little bit about our valuations. Now, one of the things I've been thinking about, a lot of this could be a self-fulfilling prophecy. And I put this index in here. I'm following it more now. I want to get a better handle on it, and I want to track it for a while and just see how insightful this is. But you can see globally, the global investors, the global slowing down economy, and especially the PMIs out of Europe, you can see that there is some less optimism there for the global investor. And I also like to look at sentiment. So you can see some of the sentiment here had trailed off, but we had a recent uptick. So hopefully some of the recent actions by the Fed and some optimism that has entered into the marketplace due to the fact that maybe the Fed is being reactive to a slowing consumer sentiment. So we've seen some uptick there recently. We'll see where that goes. A big driver of the economy is small business, and small business has lost some enthusiasm for where they're at. Kind of our most recent readings kind of are at the same state where they were at the end of the fourth quarter, and we all know that fourth quarter wasn't pleasant. So you can see they would like to see some increase there in small business optimism. It's still positive. It's still greater than 100. It's still, you look at that graph and it's still on the high end of what we've seen. It's just dipped from those all-time highs that we saw earlier within the last year or two. So are we going to hit recession? The New York Fed puts this out, and I thought this was interesting. They certainly have upticked their chances of it. So I'm curious what October's reading will look after we've had some actions from the Fed and whether, some normalization of the yield curve, what this really will indicate that. But the September reading was at almost 35% chance of it. To me, it seems high. I don't think that's the case necessarily. And part of the reason I don't think that's the case is another piece from JP Morgan. When you look at this, these are conditions that you would expect to see before you enter a bear market or a recession. And you don't see commodities spike. You don't see an aggressive Fed. In fact, the Fed's, certainly reversed course in that matter. You don't see extreme valuations. I'm not saying stocks are dirt cheap, but there's not things there that are flashing that say, hey, we're in a really difficult spot. So I do think the economy is slowing a little bit, and I think we need to see some changes in some of the global stuff, and I'll talk about that next. But I do know one of the pieces that people like to see is our third-party opinions, and you can see the third-party opinions here at a sector level, and also from Argus and S&P at the macro level for both the fixed income and the S&P targets. So it's interesting though that S&P, Schwab, and Argus don't agree on a whole lot from their sector recommendations. So it tells you a little bit about the kind of times we're in right now. But it's still expected to grow. And when I look out there, things that make me nervous, the yield curve, maybe some complacency, they certainly worry me. I'm buoyed by the employment picture that it's as good as it's been in my lifetime. I'd love to see better LEI numbers, but the leading economic indicators are still in a good place. Small business, I'd love to see more optimism there, but it's still not in a bad place, still in a good place. I am very worried about negative interest rates. Like I said, in no way, shape, or form does it make sense to me for me to loan you $1,000 with the expectation of getting 990 back. It just doesn't. And I do think, it was insightful to listen to Draghi's last speech as he was stepping down from the ECB, really pounding the table for fiscal stimulus and get away from just monetary stimulus. Having said all that, I do think markets are positioned to grind higher. I always expect more volatility. It's funny doing this on a quarterly basis. This fourth quarter is when you always expect to see it, and it's some dark days in the market at that point in time, and I was glad it didn't. I'm glad it settled down here a little bit. We moved higher. The odds of recession, if you talked to me earlier in the year, I just really didn't see it. I think the odds have increased, but I don't think the odds are in favor of it. I do expect that we'll be able to move forward with a slowing economy, and the markets can grind higher here for a bit yet. So with that, I will make compliance happy and splash the disclosure back, and then I'll go back to the prior slide. So I covered a whole lot. I know I speak kind of quickly sometimes. I wanted to get things back on track a little bit. I'm happy to answer any questions on this or anything else that the department's involved with, and hopefully you found this all helpful, and I appreciate you carving some time out.
Yeah. Hey, everybody. you know, we've hit our hour, but if anybody's got questions, please feel free to ask. You know,
hey, John, I have one more question.
Yeah, go right ahead.
Hey, with all the ticket charges at other firms racing to zero, has there been any discussions at Lincoln in addressing this, or just wanted to know if there have been any conversations about it?
You know, well, I was at the WMF meeting speaking with our Pershing person when Schwab and Ameritrade came down with those decisions, and it really upset Ameritrade's business model. Schwab's business model is a little less dependent upon ticket charges. But I asked what Pershing was going to be doing about it, and she didn't have an official line for me yet. I know she said it's being discussed. There was nothing conclusive for her to come back to me with, but I would expect we'll hear more. I don't know if Steve wants to weigh in.
Dennis is actually, he's part of the Pershing Advisory Group, and he's up there this week, and that's one of the topics of conversation. So we'll know more when he comes back on what we may likely be doing with our ticket charges. So stay tuned.
And the confirmation fees as well, or?
I don't know, Brian.
It all rolls together. We're certainly negotiating that with Pershing, and as the industry moves, Pershing will move also. I don't have a timeline on changes, but I suspect changes and some changes to our offerings to reflect the changes in the industry are probably are very likely on the horizon.
Great, I appreciate it. With the new rules having to put into writing for, you know, liquidating a money market that it was roughly $30 some odd, we're on a little bit on the expensive side. Thank you for your time.
Thanks, Ryan.
Okay,
Hi,
anybody else?
No more questions.
Yeah, I got a question. This is Brian in San Diego. I have a question about performance of, let's say, CAAMS Complete and UMI versus benchmarks that the quarterly reports that you produce. So if you look at most of the equity-oriented portfolios, we're roughly 200 basis points behind benchmark on a 1, 3, 5-year basis. The benchmarks that are in here, I understand all benchmarks are, you know, not perfect, but our benchmarks still have commodities and REITs in them, and the portfolios don't. I understand you got out of commodities, and when REITs went into the S&P 500, we sold off our REITs. But can you explain how I would explain to clients why we're consistently behind benchmarks on all time periods?
All right. So what are you doing this through? Excuse me. Brian? Are you doing this through Allbridge, or are you doing this through our fact sheets?
I'm looking at your pieces.
Fact sheets, okay. Managed is an unmanaged piece. It's been a heck of a benchmark to try and beat, to be honest with you, over the last several years.
So I'm looking at, let's say, CAAMS Complete, UMA. If I'm looking at CAAMS Complete capital growth over a 3-year period of time, if the custom benchmark is 8.12, your portfolio is 6.3 on CAAMS Complete. So that's what I'm looking at. I'm looking at your benchmarks do have REITs and commodities in it.
Brian, this is Steve Mayhew. You actually make 2 good points. First of all, you know, diversification's been diversification. So any of our asset classes that were not large cap growth, i.e. mid cap, small cap, you name it, have detracted from portfolio performance. So I think you'll see most of the asset allocators out there have underperformed in that light. And in fact, we run internal benchmarks against other asset allocators, and we're depending on the time period, we're in the top third, top quartile. But to your second point, the benchmarks that include REITs and commodities, we have been running internal benchmarks, which are much more broad-based, and we are most likely at the first of the year going to roll out a change to our benchmarks, because we did make a move in real estate. Although we put real estate in our portfolios, we have moved that up into the S&P, and we did have an allocation to commodities. We could still move into commodities. Yep. We're using infrastructure right now. But I think you have a valid point. We're aware of that internally, and we've had discussions about when we're going to roll out a change in our benchmarks, probably the first of the year. They will be broad. The benchmarks will be broader based.
Yeah. Unfortunately, everything we've done to mitigate risk has mitigated return. So.
Well, you could say commodities mitigate risk, and commodities are in the benchmark. I mean, the commodities do have the benchmarks do have diversifiers, right? And Steve, I don't understand what you mean by more broad-based. I mean, you have the Barclays Ag and Russell 3000. What's more broad-based?
No, so more broad-based was the number of benchmarks you see, or the number of asset classes in our benchmarks, I think are 5 or 6. We have large cap, small cap, real estate, commodities. More broad-based, we would have 3 asset classes. We would have a domestic, broad-based domestic index, a broad-based fixed income index, and a broad-based international index. So we would be using
the all-country ex-US index for international holdings, and the Barclays Universal for fixed income, and the Russell 3000 for the domestic equities.
Okay, thanks.
All right, and Brian, we've had this conversation. I'm happy to continue having the conversation with you. So,
and we'll keep changing our benchmarks till we look better.
That's good advice. Yeah. Hey, well, listen.
There's an old line: if you can't beat your benchmark, change it.
That's correct. Yeah, that's got to be that's a lot of money managers. Well, listen, folks. Thank you again. I hope you found this valuable. I know. I'm sure many of you did. Steve, Chris, Brian, Ted, everybody that, does work for us there at IM&R. We really appreciate the support. We're putting a lot of new assets on currently. So, hopefully we'll do this again after the first of the year sometime and have a bunch more assets to talk about. So thanks again, everybody, for the attendance, and we'll be in touch soon. Take care.
And thanks again for giving us this opportunity. We really appreciate it. Have a great day.
Thank you very much. Thank you.
Thanks. Take care.